Hey everybody, Marty Missouri, good morning. It's the 13th of May, 2019. As I speak, Dow's down right at 700 points. S&P is down almost 3%. NASDAQ is down about 3.5%. Thought I'd spend a minute or three with you on the video this morning. Recall, as we were getting up in here, I was concerned about the aggressive trade talk that sounded reminiscent of what we were getting up in here. This was ultimately the deepest correction that we've seen since 2011 during the European debt crisis. And this right now by itself on a chart looks like a normal, healthy retracement of a huge rally off of the bottom. Last video I said typically big rallies like this tend to retrace at some point, often to a 38 to 50% degree, and I said that would be somewhere down in here. Again, just normal retracements. They call these Fibonacci retracements. Just the first level of where technicians tend to target is down here at 27.23. The 50% retracement would be down here at 26.50. Of course, that's going to feel like a pretty dramatic drop from here, folks, but I could show you over and over and over again historically through the chart rally after rally after rally that retrace back down to 38 to 50%, sometimes even deeper, still within the context of an ongoing bull market. Yes, I am concerned about the news. This is something that I was writing about, frankly, when President Trump was elected, and that is the market's going to like deregulation, it's going to like tax cuts. But if he meant what he said on the campaign trail about protectionism, ultimately the market's going to hate that. He did not go there in 2017. He's gone there in a big way now. He went there in a big way here. He's there in a big way here. I know what the president is saying about tariffs and the economy. With all due respect to him, he is unequivocally wrong. Tariffs are a direct hit to the economy. They are a huge tax increase now, and the level that we are now at. We do have real legitimate concerns and complaints and issues with China and how they operate on trade. But as I've maintained from the beginning, to go there using tariffs and now to have pushed it this far is a most dangerous scenario. Consequently, we have general conditions that aren't nearly what they were. Our assessment does not have us rolling over just yet. It does not present a situation where odds favor a recession going forward, but it's a lot closer to that than it was up here. Our assessment is there is still time to make sense on trade. As long as general conditions are fine, we will see, I think, a huge whipsaw rally, which is why with our long-term allocations, we're not really jumping in here and doing anything with those. It's just not time yet. And I know it may feel like it when we feel these market disruptions, but if we've done that anytime in here, we're still better off having let things go. I don't know how much further it goes. We have the 2800, which I said should present some real support. It has so far this morning. We actually got as low as 2802. The market bounced off. Now it's coming back down to test that once again. 200-day moving average has been very important throughout this bull market. We'll see, but I'll say it once again. A normal retracement down to 38 or 50% is of course very much in the cards. It always is, regardless of the perceived reason for the retracement. So folks, I know it can be nerve-wracking. It is very troubling to me, the state of global trade, when you look at how important global trade is to the US economy and to the world economy. I've been talking about off and on of late this particular week and the concerns about the president's desire to slap tariffs on European automobiles. My best guess right now, because he is market centric, is that he will delay that decision. I think there is a provision for that. It would be unbelievable if we were to begin a tariff war with Europe right now under present circumstances. Of course, I'll keep you posted with much on the blog in terms of what we're thinking and doing. The only thing right now is what we're not doing, and we're still not allocating new cash. I really had expected to about 2,800, still might, but we could break down below that and we'd have better opportunities at lower places. Those of you like me who are invested with our allocation targets, we stay the course until conditions actually roll over and odds begin favoring a recession and therefore a long protracted bear market. Thank you as always for watching and listening. Talk to you again very soon. Bye-bye.